Hey everyone, Jeff Dorman, Chief Investment Officer at ARCA, coming back again on a Monday, June 27th here for another That's Our Two Satoshis Live. Again, we write a blog every week. It's called That's Our Two Satoshis. It's available on our website at ar.ca/blog. Trying to capture what's going on in the market. What's driving prices, what's driving sentiment. How are we thinking about valuing different instruments in this market? Been doing it for 4 years. I think it's serves as a pretty good historical reference for what's going on in the market at any given time. So last week specifically, I think most of it, what we've been doing for the last couple of months on this call, has been pretty doom and gloom. Last week, we had some green shoots. We had some positivity in the market, not just in digital assets, but across the equity market as well. Coming off back-to-back weeks where the U.S. equity market was down over 5%, pretty big snapback last week. You had the S&P rising 6%. You had the NASDAQ gaining 7%. And as such, we saw some other things thaw out a little bit as well. You saw the U.S. dollar starting to retreat, which is usually a pretty good indicator of risk on. We saw Treasury yields coming back in from a high of, I think, 340 in the 10-year down to as low as 305%. This led to a pretty favorable backdrop for digital assets. And we saw a pretty big 20 to 30% move across most names not named Bitcoin and Ethereum. And that's pretty interesting, right? We talked about this last week as well. Usually you see Bitcoin and Ethereum kind of leading the charge. Here you're seeing the opposite. And I think that's for good reason, right? Because Bitcoin and Ethereum are largely the number one and number two used tokens for collateral. And right now, most of the market's problems are based on collateral issues at some of the biggest lenders, from your retail platforms like BlockFi and Celsius to some of the institutional players, whether that be Genesis or Galaxy or whoever else. There's counterparty issues in the market, and there's collateral issues as a result of those counterparty issues, and that's weighing very heavily on Bitcoin and ETH. But the rest of the market is fairly unscathed. DeFi has been performing amazingly in terms of product fit and in terms of user usability. And you're seeing it in the market, right? DeFi was probably the biggest sector gain last week, rising over 23% across the sector, with some big idiosyncratic moves out of Maker and out of Wi-Fi. The cynic in me would dismiss this and just say it's a bear market rally or short covering. But the bull case may be that people are starting to recognize that DeFi protocols and applications did their job where their centralized counterparties failed. Shout out to Coinbase. Coinbase put out a pretty good list of all the different firms that are having problems right now, from Celsius to Three Arrows Capital to BlockFi, Genesis, BitMEX, Nexo, Babel Finance, Maple Finance, Voyager. I mean, these things all share one thing in common, and that is that these are companies with a CEO and a board of directors and humans who make decisions. And a lot of those decisions were not good recently, and that's why we're in the problem that we're having right now with regard to counterparty issues. But in DeFi, not a single line of code was capable of making these costly decisions because it's programmatic. And that's why you're seeing the lenders like Aave and Compound coming out pretty unscathed here, because they physically can't misallocate capital like their centralized counterparties did. A DeFi asset manager like Enzyme physically couldn't lie about their AUM like Three Arrows Capital did. Something like MakerDAO and the DAI stablecoin couldn't have the same human failures that Terra Luna did around the peg on UST. So you start to put all that together, combined with the fact that from a macro standpoint, there was a little bit of an easing in the market last week. And you start to think, oh, well, maybe we should be buying some assets down here, and maybe we should be buying some assets outside of our typical Bitcoin and ETH. And there was also a little bit of a rallying call last week. I thought very subtle, but CZ at Binance said the worst is likely over in an interview he did. Cumberland, in one of their internal notes to clients, said something similar about probably near the 8th or the 9th inning here. And then you had some real news being announced last week, right? FTX backstopping BlockFi and Voyager. MakerDAO announcing a $3 million buyback in burn. DYDX announcing that they're going to move their protocol from Starkware, which is an Ethereum layer 2, to its own app chain on the Cosmos IBC. Solana, with the big news, revealing their mobile platform. You start to add all these little things together, and you can see why there's a little bit of a support to the market right now, even if Bitcoin and ETH are still being wrapped up in this collateral unwind. So we'll see what this week brings. Already today, you're seeing a little bit of separation, which is good to see. You're seeing, the NASDAQ and the S&P down, but digital assets kind of holding, strong. So we'll see where it goes. But, I, for one, am a little bit encouraged with the price action. The other thing that we wrote about this week, and this one might be better to reference on the blog itself, but um, DeFi has famously given out yields in the, certainly the high teens, sometimes even in the 50 to 100% triple digit kind of range. But right now, there's no yields available, right? That's the problem with DeFi. Like, everything that created these higher yields in DeFi right now don't exist. But there's still a whole cohort of investors out there who need yield. Some of them might be better served looking at the bond market right now. The bond market for the last 5-10 years has been pretty boring, right? We've been looking at 0% yields in treasuries. We've been looking at 3% investment grade bonds, 5-6% high yield bonds. Certainly nothing interesting. But as this market deteriorates, you're starting to see real yields available across the bond market, and three of them that might be interesting to DeFi investors or digital asset investors themselves are the bonds that were issued by digital asset native companies like MicroStrategy, like Galaxy, like Coinbase. We listed three bonds in our blog, from MicroStrategy 0% convertible bonds that have a 17% yield, to the Galaxy 3% convertible bonds that have a 13% yield, to the Coinbase convertible bonds that are yielding upwards of 14%. These are pretty juicy yields, especially when these are convertible bonds, and ultimately you're still getting a very cheap out of the money call option on the equity should these companies improve. But more importantly, when you look at bonds, you look at asset coverage. You look at, are they able to service this debt? And in a bankruptcy or in a liquidation, would they have more assets than there are debt on the balance sheet? And all three of these right now, the answer is yes. So I don't think really you're going to see a shift necessarily in terms of DeFi yield farmers all of a sudden buying bonds. But I do think that those who want exposure to the digital asset space will start to look at these things. I, for instance, think Galaxy is one of the more interesting ones. They have only $500 million of debt on their balance sheet. They have 845 million of cash and 2.2 billion of digital assets. So basically, it means that their asset coverage is 6-to-1 their debt levels right now. And on top of it, their equity alone trades below book value. So, when this market does start to get back in buy mode instead of panic fear mode, things like that are clear value opportunities, that's where significant money will be put to work. And you're already seeing it, right? You probably saw the headlines last week that Goldman Sachs is putting together a $2 billion fund from their clients to go buy some of the distressed assets from Celsius. That's what the big funds will do, right? The big distressed funds will start to look for, where is their value, where is their adequate asset coverage, where is their opportunities where you can clearly see value in a company or in a project that is trading well below its book value or well below its cash flow level. And I think you'll see more of this. I think you'll see more distressed companies, distressed funds starting coming in and buying some of these distressed assets. And that should provide a little bit of a floor to the market as well. So that's it for this week. Again, we're working week to week right now, given that the market continues to change. I don't think any of us foresaw the three arrows problem. Certainly there's still some potential skeletons that haven't jumped out of the closet yet in this market. So, like everyone, we're digesting the news as it comes. We're trying to figure out what is systemic versus what is a real idiosyncratic opportunity, and hopefully we have more weeks like last week where you see some real cream rising to the crop on specific news that isn't wrapped up just in a macro or systemic meltdown. So we'll be back again next week. That's our two Satoshis for this week. I encourage everybody to read the blog at ar.ca and hit me up on Twitter or by email if you have thoughts or questions. Thanks, everybody.